Well, buckle up, ladies and gentlemen. We just had ourselves a very rare signal take place in the S&P 500, and that's what we're going to be discussing on today's Stock Market Brief show. Now, this rare bearish signal is taking place in conjunction with a lot of topping patterns. As you can see here, the S&P 500, these are known as head and shoulder patterns. But it's not just the S&P 500. You can look at the Dow Jones Industrial Average doing the same thing. The IWM is doing the same thing. The NASDAQ 100 is doing the same thing. Housing market is doing the same thing. Semiconductors is doing the same thing. The BKX is forming a very similar pattern. And XBI, will throw that in there too, actually recently broke down from its head and shoulder pattern and back tested and went down further. We have all that and more on today's Stock Market Brief show. Let's get into it. All right, everybody, welcome back to the show. Before we get into all the charts and data, I want to take a moment to just say thanks to all the patrons that support my channel, as well as my partners and various subscribers and those that leave comments as well. If you're interested in joining the Patreon group and getting that Discord access where we have all those benefits, it's only $9 a month. It's not an arm and a leg. It's cheaper than one trip to Starbucks, basically. And if that's, don't like monthly payments, which I kind of agree, you can do annually and you get a bigger discount. In there, we give all types of stuff. I still haven't updated everything that we do, so I figured I'd just show you really quick if you're interested in seeing what it looks like within there. But once you get Patreon set up and you sync your Discord, you'll have a bunch of different channels here. I give things like various trade ideas where I just give some chart setups that I'm looking at. These, like, once again, it's not an alert service. I give a watch list out pretty much weekly here. And now I've included this thing called the tight list, where if you open this up, I'll just open it up for you. Why not? Why not? The tight list is basically a candle glance view. Let me make this smaller here. Okay, so it's basically a candle glance view of just some of the names that are coiling up in the watch list, meaning they're tightening up. So you can see, a lot of bull flags in here, and you kind of go through the list and just see setups that you might like. Typically, they are in bullish context, but yeah, just a little, I guess, just a way to consolidate the watch list. I give monthly expected moves, quarterly expected moves. I give a whole list of weekly expected moves, which I'm going to be actually giving you this today on today's show. I give daily expected moves. So these are levels you can type in on your screen. If you want, you can screenshot this and add those levels currently, because that's for Monday coming up here. I also give the zones, which is a cool way to visualize an indicator that was designed by Joe Catanzara. And this indicator really allows you to see a fractal view of the markets. And I give it on a bunch of different products. So, as you can see, S&P 500 is reaching the lower end of the zone. Well, look at what's reaching at the upper end. The VIX, right? The volatility index. So there's a bunch of cool things that you can see in there. I'll just show you really quickly, actually, the PDFs, just so you have an idea of what I update daily on this. Let me just bring it in here. Like so. This is the daily zone where I give all kinds of different assets, SPY, Q, IWM, XLY, and then really what this is showing here is the lower end of the range, the upper end of the range. Think of it as like a Bollinger Band in a way. It shows you where price actually is within that range. And then it shows you if it's bearish or bullish trend based off of a Dawn chain channel. You have ARC at the lower end. So that's just some of them. I also have the S&P 100, all of the assets in the S&P 100 in there. You can see, but it's not just those. Obviously, I do a lot more. And these are, like I said, updated daily. Global ETFs, so you can see where they are within their respective ranges. Commodities, I give a whole bunch of different commodities there too as well. I do currencies, fixed income, volatility. So you have VIX, 3-month VIX, 9-day VIX, VXN, and so forth. You see a lot of the volatility, actually, now that we're going into this. It's at the upper end of their ranges there, or their zones. And then I have China in there as of right now. And, these update, they change and so forth. But that's not all. I also give, if you like my stock market charts and indicator type signal charts, I put them in this channel over here. I just have permalinks to them. And then I just recently added tradie ticks. Like I said, this is only $9 a month, and this data right here, this from Tradie Ticks that I included, is probably worth more than the entire service altogether of $9, right? This thing, I know people pay $50, $60 a month just for this type of data. But this is a query channel where you can type in if I pin the comment, various different commands. So for example, like option flow commands, where you can take, if you want to see like, hey, some divergences taking place with the algo flow, meaning saying, hey, maybe price is moving down, but there's premiums are going up. So price is diverging from that. You can get a quick screenshot of that. There's stock research commands, crypto commands. Some of the more popular ones are for traders intraday, where you can see market net flow or various ticker net flow. I like to use the market net flow. And then you also do like zero date, GEX levels, which I'm trying to look. These are just a bunch of commands that people have been typing into the channel. Yeah, so zero date GEX levels. This is actually showing you the time. So it shows you by the hour, what's being added, what's being pulled, which is very helpful. But then they also add like strikes too, for example, like if you're looking, where's the big zero date gamma exposure at? So just a bunch of cool stuff. There's also scalp bots in there. This is based off of the strat. So if you want like entry targets and, the type of position and the stop loss level, this is all based off of what's known as the strat. If you don't know the strat, you can Google this strat. They have bullseye bots, which is different way of looking at order flow. They have golden sweep, so options, big sweeps, right? Large sweeps that aren't quite as big as the golden. You have dark pool bots, insider bots, and so forth down the list. Then you have access to the community as well, where we do, just various different channels there for the community. So yeah, quite a bit of stuff. You can also check out the other links in the description where I have access to bookmap discounts, and then also Interactive Brokers is one of my partners as well. Alrighty, so thanks for letting me get that out of the way. If you're interested, once again, the links are in the pinned comment below. We're going to take a look at the charts now. We're looking at the week-to-date performance heat map of the S&P 500, and it was a blood red week. Tesla was down 10%. Apple was basically unchanged. Microsoft down 4%, Nvidia down 5%, Google down 5%, Amazon down a whopping 8%. And these large market cap names, they pull a lot of weight in the S&P 500. But let me remind you what the year-to-date performance looks like. The year-to-date performance is still up tremendously, so they're taking a little bit of a fall from grace. The question here that I'd ask myself is, what would it look like if Nvidia only finished up 100% year to date? What would it look like if Tesla wasn't up 100%, if it finished up only 50%, which is still tremendous? But knowing that these large market cap names have just seen large runs, and to be cut in half from where they currently are, or at least not cut in half fully, but cut in half these gains, what would that look like for the overall S&P 500? And we're talking about this in conjunction with obviously a lot of topping patterns which we previously noted there. And this is also taking place on the back of a yield curve that is deeply inverted, which has been one of the best indicators of recessions to take place in the near future. This is the 10-year, 3-month yield curve we talked about prior, and we're deeply inverted at levels that we haven't seen past the 80s over here. And you can see this is also took place where the 2020 recession happened, greatfinancialcrisis.com, 1990s. But really what happens here is when they uninvert is when the problems really start to occur. The Fed, we already know, is in a tightening cycle. You can take a look at their balance sheet. It dropped off here once again this last weekly reporting. And obviously rates, they're planning on holding them higher for longer. According to the last meeting, we're currently at 5.33, which is, just about where we were at in 2006, 2007. And they plan, like I said, holding them higher for longer to fight inflation. So that is the plan is now. And I want to also remind you that these type of things have a massive lag effect. And the lag effect can be seen on this chart. This was posted by Keith McCullough on his Twitter. And basically what this is showing is policy tightening begins to meaningfully impact consumption growth in around 14 to 16 months. And, while he posted this, it was, I believe, this was June. It's now September. We were in month 15. So we're more in the middle here where we start to see the breakdowns really occur. And you're really seeing that in various charts. Like, for example, if I pull up, consumer staples, which gives a good idea of, what's the consumer look like, and I'm pulling up 52-week lows, around 0 to 5% off the 52-week low, you're seeing a lot of charts that are big market cap names. Hershey, MO, which is Alitura, I believe that's a tobacco company there, and then General Mills, Cisco, Campbell Foods, Smuckers, Kellogg, just some very big names there. You can also look into like utilities. These are rate sensitive, and we already know what's been happening with the rates, but NEE, AMP, right? So some big utility names, they're all sitting at around 52-week lows. And if I just pull up new 52-week lows around 0 to 5% from the low, you can see things like Disney, which is a big one that has, really focused in on the consumer, right? And then you have, like I said already, NEE, BMY, Citigroup, which is obviously the bank. That's sitting there, right around the lows where it was during the Silicon Valley bank collapse General Motors. So some very big market cap names all sitting around these 52-week lows as it stands right now. And this is also taking place on the back of the loans and leases. You can see here year over year, this is contracting. So credit growth is contracting. And typically when you see credit growth, it doesn't mean a recession is bound, but prior to all recessions, there was credit growth contracting. And you could see that right here with the gray shaded area, contracting, gray shaded, contracting, gray shaded, contracting, recession, contracting, recession, contracting, recession. We even contracted a little bit here to see that recession. Now we're seeing a pretty large contraction here year over year. And that could potentially give us insight into a recession up ahead. Now, during the banking collapse, the Fed came in with what's known as the Bank Term Funding Program. I just wanted to point out here that when it came out, while the S&P 500 was kind of just flustering around the lows, when Silicon Valley Bank blew up, this really helped the market. The market had some relief, but now it's starting to flatten out here. And I look to see, hey, what did we report on the most recent report here on 9/20? Well, it was actually a decrease, and we've only had 4 times since this came out where we saw decreases take place. And you could see that basically right here, right here, right here, and then just recently there. And during these decreases, you can see S&P 500 went sideways. During this decrease, and basically it's been flat to unchanged. The market hasn't really gone anywhere there too. So I don't know if that correlation is going to hold, but if this starts reducing or potentially upticking, it could be beneficial if it goes up for the markets. But if it starts, down ticking a little bit more, it could spell that we might have some further downside in the market. So it's something might to be keeping an eye on. If we take a look at the 10-year yield, this is why I started hearing people say this is a double top, and why I just kind of criticized that on prior videos. This is not a double top. This is a test of prior resistance. A double top would be if price came from here and then cracked the low right here. Then it would technically be a double top. And as you can see, we came up, we consolidated more, price tightened up, right? Just like the tight list I showed you from the what happens in the Patreon or in the Discord, the watch list section. Price moves between expansion and contraction, and it contracted right here, coiled up, and this thing fired off on the Fed announcement or shortly thereafter up to around 4.5%, and it just backed off slightly there. If you look at the monthly time frame for TNX, which is the 10-year yield, we do have a divergence that formed way back in the 80s. Okay, and we have another monthly divergence forming as it stands right now. This marked the top right there. So, hey, it doesn't mean that it has to respond right away, but even if this goes up a little bit more and this goes up a little bit more, the divergence could potentially still be in works and building as it stands, meaning that we could be nearing the top in the 10-year yield, which could offer an opportunity potentially here in the near future for bonds. If we take a look at the dollar has also been moving higher, and you can see here, all right, we started seeing a strong move. What happened to the S&P 500? It started getting weaker. Just like here where we topped in the dollar, we actually bottomed in the S&P 500. So it's another very important asset to watch from an intermarket standpoint. If I show you the monthly time frame, this thing looks like it just had a monthly breakout, right? The month isn't over yet, but we got back above the 20 monthly simple moving average, which is in the middle of the Bollinger Bands. It broke out of this little downsloping trend, and it's kind of coming out of this prior area of resistance. And once resistance is broken, backtesting could potentially become support. And it did. This Bollinger Band is starting to move up. This one's starting to come down, meaning contracting. So if it starts popping up, pay attention to that 110 to this 112 area, and that could be a potential prior area of resistance, prior area of support can become a prior area of resistance for the dollar there. If we take a look at some other big charts to really give you an idea of how the consumer is doing, something like the Russell 2000 will give a good barometer of our economy. And this right here, I'm just highlighting the weekly line chart, and you can see dating back to the financial crisis, we've been in this up channel, right? So you have this low here, and then you have this low connected, okay? And then you have this high here where we had this flag where it really broke down. We had it tested here, and we had it tested here. And then the middle line, you can see it's been holding a support. And we broke down, saw a quick move, then acted as support there, and then it's been kind of acting as resistance most previously right over here this year. Something that I noticed on this chart here is during hiking cycles, kind of where it starts to flatten out, during the hiking cycles where it starts to flatten out during the hiking cycle, and then we're going to hold it higher for longer. We'll see if they want to raise more, if they're going to flatten out. But what you'll notice here is I have these blue arrows pointing to the price of the IWM, and it's typically consolidating. And it's not until something breaks where the Fed moves rates back down to zero, and then you see, the strong moves in small caps and even XRT, which is retail. You can see as the rate goes up, boom, we drop down. Where did the price perform the best? Well, the price performed the best for retail stocks while rates were at zero. Why? Well, because money is cheap, right? Money is flowing. The consumer is spending. And look at what happens when we start to raise rates during the rate hiking cycle. Well, it didn't go anywhere. So guess what? Something broke, move rates down to zero, rockets off like a rocket ship. We start moving back up, starts coming back down, starting to consolidate here. So is something going to eventually break to the point where we have to move rates back down quickly, which could, maybe result in a stronger move to the downside? But when they start reducing rates back again, if that's going to be the case, could that be the best time to start looking at things like XRT or various retail stocks and potentially even small cap stocks as well? As you can see here, this thing is contracting and it's been doing so for a year. You have a high, matching highs here, higher lows here. It's coiling up, and a break, I'd start looking around that 150, 160 level potentially if we start to break down lower from that point. Now, we talked about the bearish signal, the one that's very rare. This hasn't happened since the third quarter of 2007, and it is the third quarter now of 2023. And the signal that I'm talking about is the PMO bearish crossover. This is a price momentum oscillator. This is different than the MACD. I'm not going to get into the specifics difference, but to give you more insight on the price momentum oscillator, the reason I like this, especially on weekly, monthly, quarterly timeframes, is because it's using something known as the rate of change. And I talk about the rate of change here frequently. So this is the rate of change calculation is smoothed twice with exponential moving averages that use a custom smoothing process. And I just wanted to call out that we are not ending the quarter yet, but it's very rare to see a bearish crossover take place. Like I said, the only other times that this bearish crossover has taken place was the third quarter of 2007 and then also here in 2001, and both led to further downside. It doesn't mean that that's guaranteed to happen, but understand, being a quarterly chart, a quarterly time frame, it takes a lot of effort and a lot of strong moves to get this from being a bullish, crossover from way over here in 2011-12, where we saw this large move, to have a bearish crossover, okay? So it takes a lot of strength for that to happen. Now, this is all taking place in one of the, most seasonally weak months, and that is September, where, a lot of crises have happened in the month of September, and we talked about that on prior videos. We're moving into day 16 to 17 starting Monday, and this is where things kind of flatten out. But remember, right, September typically starts off weak and it ends weaker, and this is really following the script, right? If I just pull up a chart of the SPY, it starts weak, we see this little bounce, and then it finishes weaker. Very similar where we started weak, we had this bounce, not quite, as strong of a bounce, and now we're finishing weaker as it stands. And going into this next week, there is, a whole host of macro data that's going to be coming out, which is really adding to the potential volatility that we're going to see. And we'll get into that here momentarily, but we have, we have some Fed speak taking place. We have Case-Shiller home pricing data coming out, new home sales, and then some of the bigger reports are like durable goods. That could be a big one to watch on Wednesday, an hour before the market opens up there. And then also on Thursday, we have GDP growth rate. And then Friday, we have personal spending, personal income, core PCE. So we have a whole host of data coming out. Now, this last week, we already know that there was a lot of red on the screen. And these are some very outsized moves, and it caught the markets pretty off guard. And I know this because the markets like to price in future risk. And we look at that, it's called implied volatility, and we look at those expected moves. So these were the, the weekly expected moves going into this last trading week. You can see here for all the various different assets, but the S&P 500, I'll just use the SPX. It had a $60 expected move. The Qs had a $7 expected move. SPY was a $6 move. And what you're seeing here on this column to the right is, I colorize them. So if it's red, it finishes outside the weekly expected move. And you're seeing all these big products here that are, optionable. They have traded basically outside of their weekly expected moves, but not by a small margin. Look at the SPX, 43.20 was where it closed, and the 2 sigma move, 2 standard deviation move was at 43.30. So we had a 2 standard deviation move in the big boy product over here, S&P 500. And you can see that here on the monthly time frames. We have monthly expected moves. We have the S&P 500 right now outside of its monthly expected move. And if you think of this in terms of probabilities, right, 68% of the time it finishes there up within it. But as it stands right now, we're currently outside. The dashed lines is the quarterly expected move, and we're perfectly right there. You know, even if we're to come down to 4,200 before this month is over, right? We'll take a look at the quarterly charts when that happens. We'd still be in with what the options market pricing as far as forward-looking risk for the S&P 500 for the quarter, but definitely the month is currently outside of it. The Qs so the NASDAQ 100 or the Qs is actually just an inside trading month. So nothing crazy here, really. It's actually just consolidating. Yeah, it's scary because it's down 5.17%, but as it stands right now, it's just an inside trading month, and we are currently outside of that lower monthly expected move. IWM here is seeing more weakness, and we're not too far off of that quarterly expected move. And people are telling me it's a new bull market, but we've been talking about the divergence between small caps and like the Dow Jones and the S&P 500. And I'm telling you now, right, it's still there. The divergence is still there. And this thing is not in a new bull market. It doesn't take a genius to know this. If you measure the top here and you go 20% down, that brings us to this red shaded area, and we are in it. And that means that we're 20% off, 20% plus off, right, from the all-time high, or from this prior swing high that was the all-time high. And that means we are in a bear market, and you can just see this thing kind of flagging, consolidating here. So if this thing breaks down, watch out. Now going into next week, the reason why I showed you those weekly expected moves is just to show you not only do we have more macro data coming out, but look at what the options market is doing now. The SPX now has an $84 expected move. If you want to screenshot this and put the levels on your chart, this is the sheet that I share with my Discord community, Patreon group, and this is going into next week for all the products, so I figured I'd just share there. But just note that the SP 500 had only a $60 expected move, so volatility is obviously, puffer fishing out right here. Now we're seeing about an $84 expected move, letting us know that, hey, we can see strong move to the upside, strong move to the downside. So pay attention to these levels like 4,400 and then also 4,236 to the low end for the SPX. All right. And remember, I talked about the zones, how we're actually kind of at the lower end of some of these. So to see a bounce, it's totally normal to see a bounce. Where you'd see a bounce to, well, maybe you can see these weekly expected moves and even daily expected moves that we have recently just shared. Okay. Now let's take a look quickly at back month versus front month volatility. I bring this out typically when we have this strong rally in the S&P 500, and you could see this yellow line here. I want you to pay attention when it gets to about 1.2, which means it's 20%. It means a back month is roughly 20% higher than front month, or just volatility index. And you could see when we get up to these areas, we go through periods of consolidations, or it could mark potential topping points like it did right here. Then we talked about it right here, and then it started to sell off. But, for the year of 2022, you can see if I just draw these times right here, and I just scroll down, boom, 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 you can see it's marked some pretty critical topping points. However, on the flip side of that, if you look at here where we start to reach these bottoms, the flip side is it actually potentially marks short-term bottoms where you see these little bounces, short-term bottom, where you see these little bounces, and then even right here. And I just wanted to call out, we're not quite there yet, but if we do get some outsized move where we get around that 1%, or it's 1 for 1, that right there could mean a potential, point where we start to chop around, consolidate, or see some relief in the S&P 500. This is all taking place too as the summation index gave us some insight right here as the potential change in trend, right? It gave us a potential change in trend right here, right? And it kind of just went sideways, consolidated, we fish hooked, and then it reverted and started heading down. I do see a positive divergence currently building with the NASDAQ McClellan oscillator as price made a new low from this prior low, but yet the internals are showing us it's not as dramatic, meaning that this can get dramatic and it could still go, but as it stands right now, we have a higher low where we have a lower low, understanding that there's a subtle divergence there taking place. Now, if we take a look at the SPY on the 15-minute time frame, yes, it was a wild trading week. Where can we potentially look for potential bounces? I'll give you my insight now. First, I want to start by looking at all the lines on the screen. These lines, they all represent something different. We have the green one, that's the quarter to date anchored VWAP. We're well below it, meaning the average buyer based off of volume and the time of the start of the quarter is underwater. So it's not a good quarter for the majority of people buying based off of a volume, okay? Then we have the month to date. Okay, we're below September, right? So way below it as it stands right now. So the average buyer based off the volume is underwater there. Okay, we're below the week to date. This was last week, okay? We finished way below it. When it gets below it, just be careful, be cautious, right? If we're above it to start the week, which on Monday, it's going to be the daily VWAP, but we hold that anchored in, that'll be the week to date. So if we're above it, cool, bullish, and we play to the upper weekly expected moves, okay? Which there are all these levels here, which I'll go over. The purple line is the 5-day moving average. Now, the 5-day moving average allows us to see visually trend. And I always say when we break it, okay, there's a couple of things you look for. Just because you break it, it does not necessarily mean it's going to be bearish. I look at the direction of the 5-day moving average. And the direction of the 5-day moving average as it stands right now is down. And price is below it. Okay, now price is getting pretty extended from it. So as it stands right now, price is below it, bearish, declining, that's bearish too. Okay, so two ideals are in your favor of being more bearish leaning. That doesn't necessarily mean short. It means you wait until you're more bullish, unless if you are a short, if you like to short the market. Okay, so when do you get bullish? Well, when you get bullish is when the 5-day moving average starts to flatten out. Okay, price can still be below it, which means it's bearish, but more of a neutral trend. Okay, but if price starts to get above it and it's neutral, it means you're bullish, but with caution, right? So on a neutral trend and price is below it, it's bearish with caution, bullish with caution, okay? But then what you want to see is price to start holding above it and start moving higher like so. Then we have a bullish trend, price is above it, that's bullish, and then we start to look for various patterns to form. Now, being as that is currently, you can clearly see the trend is short-term bearish. And during these times, a lot of trade setups for swing traders, what I've noticed from my personal style, which is breakout trading, if we're in a bearish trend and price is below the 5-day moving average in the SPY, a lot of swing setups, they don't work all too well from a breakout perspective. It works a lot better when we have a trending market and price is above it. Go figure. Now, that doesn't mean that you can't catch short-term bounces. So what levels do we look at? I like to look at the daily expected moves. These are the daily expected moves going into Monday. And then I like to look at potential areas of resistance and support. So as it stands now, I noticed this little trend line being tagged multiple times these last few trading days. And if we start breaking back above that level at some point, that opens the door to at least potentially strike the upper daily expected move to potentially the upper weekly expected move. But you want to pay attention to obviously these declining averages and also the daily VWAP as well. Now, one of the other levels I look at here sometimes is the RSI to see if there's any divergences that build as price gets hit from the downside where it gets very extended from the 5-day moving average, or if it goes way above the 5-day moving average too and sometimes becomes overextended, right? I don't like to FOMO short and try to catch a strong move after strong move, and I don't like to FOMO long after the price has moved to strong move. I like to wait for various signals and confirmation of price action to guide me. And as it stands now, we have a low, a lower low, a lower low, and we have a high, or we have a low, a higher low, and a higher low. So the RSI is currently diverging as it stands on this shorter time frame. That means it could build for a while. Like we can see price go like this, and there still might actually be technically a divergence in place. So what I would look for is to break this trend line, potentially back test it, look for strength. You can have a stop loss like so, and then play it to the upside. If not, and we get further downside, which has been pretty weak so far, start to look at the lower daily expected move, and you might be able to play some levels in and around that area. And then also, if we get a very outsized move to start the week, start looking at 422-ish, and that is the lower weekly expected move for the SPY. So just to conclude, and we talked about a lot, right? There's a lot of bearish things taking place. We had a very rare signal occur. This is a quarterly time frame chart, so this doesn't mean it has to be instant, but we'll constantly watch to see if this turns back around. We're in a period of seasonal weakness. We mapped out some various key levels, and we noted that the current trend for the short term is bearish. So you must be cautious if you're trying to catch a bottom. It does help to use signals like this volatility back month versus front month. You can use things like the summation index and these positive divergences. You want to see this turn back up and so forth. But you can learn more, obviously, if you just subscribe to this channel. We'll share these charts very regularly. That's all I got for you. See you later.